Ladies and gentlemen, welcome back to the channel. I'm your host, and if this is your first time here, you've just stepped into a community of serious investors who don't chase hype, we chase returns backed by data. On this channel, we break down market-moving stocks, analyze quarterly reports, dissect financial statements, and most importantly, we identify opportunities before they become obvious to everyone else. If that sounds like your kind of investing, hit that subscribe button and turn on notifications, because we post content like this every single week. Today's video is one you absolutely cannot miss because we're covering 3 stocks that could define your portfolio's performance in 2026. These aren't random picks. These are carefully researched companies with billion-dollar revenues, industry-dominating positions, and growth trajectories that have Wall Street's top analysts raising their price targets. So grab a notepad, get comfortable, and let's dive into the 3 best stocks to buy right now for 2026. Now, if you're looking at your portfolio right now and wondering where to position yourself for next year, you're in exactly the right place. Because today, I'm breaking down 3 stocks that aren't just riding trends, they're creating them. These aren't speculative plays or meme stocks. These are companies with fortress balance sheets, dominant market positions, and growth trajectories that could make early investors very, very happy. I know what you're thinking. Everyone and their grandmother is talking about certain sectors right now, but here's the difference. I'm going to show you the actual numbers, the real partnerships, the quarterly data that Wall Street analysts are poring over, and most importantly, why these 3 companies are positioned not just to survive the next market cycle, but to absolutely dominate it. We're talking about companies that reported combined revenues exceeding $400 billion in their most recent fiscal years. We're talking about profit margins that would make any CFO weep with joy. And we're talking about strategic moves, acquisitions, partnerships, and infrastructure investments that are setting up decades of competitive advantage. Before we dive into the specifics, let's talk about what makes 2026 such a critical year. We're standing at an inflection point in multiple industries. Artificial intelligence isn't coming. It's here, and it's being monetized at scale. Cloud computing has moved from a nice-to-have to the absolute backbone of global business. And in healthcare, we're seeing breakthroughs in biotechnology that seemed like science fiction just 5 years ago. The companies I'm sharing today aren't on the sidelines of these revolutions. They're writing the playbook. But here's what most people miss. It's not enough to just be in the right sector. You need companies with pricing power, with switching costs that lock in customers, with research and development budgets that dwarf their competitors, and with management teams that have proven they can execute quarter after quarter after quarter. That's what separates a good stock from a generational wealth builder. And that is exactly what we're analyzing today. Companies that check every single one of those boxes, and then some. Whether you're a value investor, a growth investor, or somewhere in between, by the end of this video, you'll have 3 actionable investment ideas backed by hard data, not hype. Now, let's talk about our first pick, and I promise you, this one is going to get your attention. This is a company that has become absolutely synonymous with the artificial intelligence revolution. When people think about AI computing power, they think about this company. When data centers around the world are being built or upgraded, this company's products are the first call. We're talking about NVIDIA, ticker symbol NVDA. And before you say, oh, everyone knows about NVIDIA, let me stop you right there. Because what most people do know is just how insane the growth has been and how much runway is still left. In their most recent fiscal quarter, NVIDIA reported revenue of $35.1 billion. Let me repeat that, $35.1 billion in a single quarter. That's up 94% year over year. Their data center revenue alone hit $30.8 billion, representing a 112% increase. These aren't just good numbers, these are historically unprecedented numbers for a company of this size. But here's where it gets really interesting for us as investors. NVIDIA's gross margin in the most recent quarter came in at 75%. 75%. That means for every dollar of revenue, they're keeping 75 cents before operating expenses. This is the kind of margin profile you see in software companies, not hardware companies. And it speaks to something critical. NVIDIA isn't just selling chips. They're selling an entire ecosystem that customers literally cannot replicate anywhere else. Their CUDA software platform, their AI enterprise suite, their networking solutions through the Mellanox acquisition. This is a moat so wide that competitors need billions of dollars and years of development just to attempt to cross it. The company's net income for the quarter was $19.3 billion, giving them a net profit margin of 55%. Half of every dollar that comes in is pure profit. These are the kinds of numbers that make you sit up and pay attention. Let's talk partnerships because this is where NVIDIA's dominance becomes crystal clear. They're working with every major cloud provider. Microsoft Azure, Amazon Web Services, Google Cloud, Oracle Cloud. Every single one of them is buying NVIDIA's H100 and H200 GPUs by the thousands. OpenAI, the company behind ChatGPT, runs on NVIDIA infrastructure. Meta's AI research, NVIDIA. Tesla's full self-driving training, NVIDIA. The company announced expanded collaborations with Amazon on custom AI chips, with Microsoft on AI supercomputing, and with Google on accelerating AI workloads. They're not picking winners in the AI race. They're selling shovels to everyone in the gold rush. And here's the kicker. Demand is so high that lead times for their top-tier GPUs are still measured in months, not weeks. The company's CEO, Jensen Huang, has said publicly that demand for their Blackwell architecture which is their next generation platform launching now, is insane. And when you have a CEO willing to use that word on earnings calls, you know something special is happening. Now let's talk about what's coming. NVIDIA isn't resting on its laurels. They're pushing into automotive with their Drive platform, which is being adopted by multiple car manufacturers for autonomous driving. They're expanding in healthcare AI with their Clara platform for medical imaging. They're even making moves in quantum computing and robotics. The total addressable market for AI infrastructure is estimated to reach $1 trillion by 2030, and NVIDIA is positioned to capture a significant portion of that. Analysts from firms like Melius Research have price targets ranging from $160 to $180 per share, representing substantial upside from current levels. But here's my take. This isn't about trying to time a quick pop. This is about recognizing that NVIDIA is building the infrastructure for the next computing paradigm, just like Intel did for PCs and Microsoft did for software. When you look at their R&D spending, they invested over $7 billion last fiscal year. You realize this is a company that is not just defending their position, they're accelerating away from competition. Moving to our second pick, and this one is all about stability meeting innovation. While everyone's chasing the next hot AI startup, smart money is looking at companies that have been playing this game for decades and have the balance sheets to prove it. We're talking about Microsoft, ticker MSFT, and if you think you know this story, I'm going to show you angles you probably haven't considered. Microsoft just reported quarterly revenue of $65.6 billion, up 16% year over year. But here's what makes Microsoft special. This isn't growth built on hype or speculation. This is growth built on 30-year customer relationships, enterprise contracts measured in billions, and a cloud platform that's becoming more essential to business operations every single day. Azure, their cloud platform, grew revenue by 33% in the most recent quarter. But it's not just the growth rate, it's the quality of that growth. Microsoft is signing multi-year, multi-billion-dollar deals with companies like AT&T, which signed a $2 billion Azure contract, and with the Department of Defense on various cloud initiatives. Now let's talk about their AI integration, because this is where Microsoft has made moves that I think the market is still underpricing. Through their partnership with OpenAI, in which they've invested $13 billion, Microsoft has first access to every new model OpenAI develops. They've integrated ChatGPT functionality directly into Azure, into their Office 365 suite through Copilot, into their search engine Bing, and into their developer tools through GitHub Copilot. Microsoft 365 Copilot, which costs $30 per user per month on top of existing subscriptions, is being adopted by companies like Visa, BP, and Lumen Technologies. Think about the math here. Microsoft has over 400 million paid Office 365 seats. If even 10% of those eventually adopt Copilot, that's 40 million seats at $30 per month, which is $14.4 billion in annual recurring revenue from a product that did not exist 18 months ago. And early adoption rates are suggesting that penetration could go much, much higher. Their gaming division, which includes Xbox and the recently acquired Activision Blizzard for $69 billion, reported revenue of $5.4 billion last quarter. This acquisition, which was the largest in gaming history, gives Microsoft control over franchises like Call of Duty, World of Warcraft, and Candy Crush. But more importantly, it accelerates their Game Pass subscription service, which now has over 34 million subscribers. This is Microsoft applying their subscription playbook, the same one that made Office 365 such a cash machine to gaming, and it's working. The company's overall gross margin sits at an impressive 69%, with operating income of $30.6 billion in the most recent quarter. These profitability metrics give Microsoft the financial flexibility to invest in AI, in infrastructure, in acquisitions, without ever putting their dividend at risk. Speaking of dividends, Microsoft has increased their dividend for 19 consecutive years and currently yields around 0.75%, while also buying back billions in stock each quarter. Here's what I love about Microsoft from a risk-adjusted return perspective. You're getting exposure to multiple growth vectors, cloud computing through Azure, AI through OpenAI and Copilot, gaming through Xbox and Activision, and even LinkedIn, which quietly generates over $15 billion in annual revenue. But you're also getting the stability of enterprise contracts that renew at rates above 90%, a balance sheet with over $80 billion in cash and short-term investments, and a management team under Satya Nadella that has overseen one of the greatest corporate transformations in business history. The stock has compounded at over 28% annually since Nadella took over in 2014. That's not just beating the market, that's obliterating it. Analysts from firms like Wedbush have price targets of $525, representing solid upside from current levels. But more importantly, this is a stock you can buy and sleep well at night knowing you own a piece of a company that is simultaneously a blue-chip dividend payer and a leading AI innovator. Now for our third and final pick, and this one's a bit different. This is our higher risk, higher reward play, but it's grounded in science that could literally change millions of lives. We're moving into the biotech sector, and specifically, I want to talk about companies working on breakthrough therapies in areas like obesity, oncology, and rare diseases. The biotech sector has been beaten down over the past 2 years as interest rates rose and speculative money left the market. But here's what smart investors know. The best time to buy biotech is when nobody wants it, especially when you can find companies with drugs in late-stage trials or recently approved therapies that are just starting to ramp revenue. Companies like Vertex Pharmaceuticals, which dominates the cystic fibrosis market with over $9 billion in annual revenue and has promising programs in pain management and diabetes. Or companies like Regeneron, which has blockbuster drugs like Eylea for eye diseases generating over $6 billion annually and a robust pipeline in immunology and oncology. The beauty of biotech at this stage of the cycle is that you're buying companies whose valuations have compressed, but whose science hasn't changed. Take the obesity market as an example. Drugs like Wegovy and Ozempic have proven that there's massive demand for effective weight loss medications. This market is projected to reach $100 billion by 2030. Companies working on next-generation obesity drugs with better side effect profiles or oral formulations instead of injections could see explosive growth. Or look at cancer immunotherapy, where companies are developing treatments that help the immune system recognize and attack tumors. The checkpoint inhibitor market alone is worth over $40 billion annually and growing. Biotech companies with novel mechanisms of action in this space, especially those targeting solid tumors where current therapies have limited efficacy, represent asymmetric upside opportunities. What makes biotech compelling right now is the combination of scientific advancement and valuation compression. Many quality biotech stocks are trading at significant discounts to their peak valuations, despite having more advanced pipelines and more de-risked assets than they did at those peaks. When you can buy a company with an approved drug-generating revenue, a strong balance sheet, and multiple shots on goal in the pipeline, you're getting paid to wait for catalysts. Those catalysts might be FDA approvals, positive trial data, partnership announcements with big pharma companies looking to bolster their pipelines, or acquisition interest. Mergers and acquisitions in biotech have been heating up, with companies like Pfizer, Bristol Myers Squibb, and Johnson & Johnson all making multi-billion-dollar acquisitions of biotech companies with promising assets. For investors, this creates a floor under valuations while maintaining upside optionality. Here's how I'd approach the biotech pick in your portfolio. Look for companies with at least 2 to 3 years of cash runway, so they are not forced to dilute shareholders in a down market. Find companies with revenues, not just burning through cash on early-stage research. Target companies with drugs addressing large markets. Think common cancers, metabolic diseases, cardiovascular conditions, not ultra-rare diseases where the addressable market is tiny. And finally, look for management teams with track records of successful drug development and commercialization. The biotech landscape has companies that check all these boxes and are trading at valuations that could deliver multi-bagger returns if their pipelines execute. The risk is real. Drug development can fail, regulatory approval isn't guaranteed, and timelines can slip. But that's why this is our swing for the fences pick, the one that could turn a modest position into a portfolio game changer, if the science works. Now, before we wrap up, let me show you this quick infographic that summarizes everything we've covered today. On your screen right now, you can see our 3 picks laid out clearly. First, we have NVIDIA, the AI infrastructure play with $35 billion in quarterly revenue, 75% gross margins, and partnerships with every major tech company on the planet. This is your high-growth momentum play with analyst targets, suggesting significant upside. Second, Microsoft, the stability king with $65 billion in quarterly revenue, Azure growing at 33%, $13 billion invested in OpenAI, and a 19-year dividend growth streak. This is your sleep well at night stock that also gives you cutting-edge AI exposure. And third, our biotech growth pick, the higher risk, higher reward opportunity in companies developing breakthrough therapies in massive markets like obesity and oncology, with the potential for multi-bagger returns if the science executes. 3 different risk profiles, 3 different sectors, but all positioned for significant appreciation in 2026. So there you have it, 3 stocks that could define your portfolio's performance next year. The key is understanding your own risk tolerance and building positions accordingly. Maybe you go heavy on Microsoft as your foundation, add NVIDIA for growth, and take a smaller swing with biotech. Or maybe you're more aggressive and weight NVIDIA higher. The beauty is these stocks give you diversification while all offering compelling opportunities. As always, this is not financial advice. Do your own research, consult with your financial advisor, and invest according to your personal situation. If you found this analysis valuable, smash that like button, drop a comment telling me which of these 3 you're most excited about, and subscribe if you haven't already, because we're building a community of serious investors here. Share this with anyone in your circle who's serious about building wealth through smart stock selection. Until next time, invest smart, stay disciplined, and I'll see you in the next video.